So servicing, what is it? Well, it's the second C in our 4 C's of credit, and it's capacity. Capacity to service the loan. Does the borrower or the borrower group have sufficient income to service the obligation from drawdown to expiry? Very important to understand if the borrower has PAYG income, is self-employed, has other income sources such as trust distributions from part or whole business ownership. Very important to collect as much information as you can on income sources to demonstrate A, an understanding that that's been investigated, and B, to demonstrate that the servicing capacity is viable. This can be done on an interest-only basis via an interest coverage ratio, or you can look to a debt service coverage ratio, which will include principal reductions. If you could paint a bit of a picture around what servicing approach you have taken and demonstrate that the borrower can successfully meet servicing those obligations, that's going to help us in terms of a credit decision get back to you as quickly as possible. We often get questions around servicing capability or capacity of the borrower and the exit strategies. And they're both very different things. The servicing profile really revolves around the borrower's ability to meet an ongoing obligation, i.e. the loan payment. But the exit strategy for us in private lending, being short-term asset lenders, is action driven. So it requires the borrower to take an action to repay the facility. Now that can be by refinancing, but we need to test the borrower's capability to achieve that refinance. We'll take the loan application. If the primary exit is to be refinanced, then we must test that exit. We must test the borrower's capacity to successfully achieve their exit and ensure that we are lending responsibly and not setting borrowers up to fail. It's important if there is a primary exit and a secondary exit that we understand what they are, and if there is a fallback position, that fallback or that backup repayment strategy is bankable. We must have a viable exit. So the clear difference between servicing, which is the ongoing obligation, versus the exit are two very different things. However, they do converge when an exit is refinanced, because we need to test the income generated by the borrower and the ability for that income to support the exit, which is refinance. So servicing, exits, very different. Sometimes they do come together based on a borrower's income profile. So be sure to capture the income profile in as much detail as possible.